My name is Raj Chakrabarti. I'm a senior partner with Kochhar Co. I head the Mumbai team. Very briefly, for those who may not be very familiar with the firm, Kochhar Co. is one of the largest and leading full-service law firms in the country. We have 7 offices in India and 3 offices abroad, and we represent some of the largest global corporations and Indian public corporations across various sectors, across variety of laws. So we offer a one-stop service to all our clients. Now, before we get into the substantive part of today's program, one housekeeping announcement. So all the participants, except for the panelists, of course, will be on mute during this presentation. If anyone has any question, kindly use the chat box to put your question to any of the panelists, and at the end of the session, your questions would be taken up. You may also want to mention about the organization that you represent for the panelists to better understand your questions and the context. So with that, let's come to the substantive aspect of today's presentation. The finance minister presented today the union budget, which is the last full budget before the general elections next year. Now, of course, the politics aside, the political angle is of course relevant, but this budget was significant or is significant for multiple reasons. Given the current global socio-economic situations, the geopolitics, etc., the inflationary pressure that is there, threat of recession in United States and also perhaps in Europe. So these things make the budgetary exercise that much more important and that much more contextual. Coupled with the fact that, the India growth story is still probably intact, some would argue, though the growth is expected to slow down at 6.5%, but still it is the fastest growing economy worldwide, which is no mean feat. So to address that, what does the finance minister have to say? So finance minister has come up with a number of, somebody would say, big ticket announcements today, including number of tax relief measures, push for capital expenditure, infrastructure, management of fiscal deficit. Not much surprise there in terms of these broad objectives, but what's the fine print? What are the hits? What are the misses? So to discuss all these and more, we have assembled today a very, very strong panel who come with wealth of experience in their respective areas. The way we would do it is we would divide the presentations into 2 parts. The first part will be the direct tax, and the second one, my colleagues will take up the indirect tax part of it. So to present the first part, which is the direct tax proposals in the budget, I would request Mr. Shahid Khan, our senior partner and head of our direct tax practice, to take the floor. Briefly, Mr. Khan is a very well-renowned authority on Indian income tax laws. He has over 4 decades of experience, a former member of Central Board of Direct Taxes, and also a member of Indian Revenue Services. He advises clients on variety of intricate tax issues, both domestic as well as cross-border. He appears before the Income Tax Appellate Tribunal, various high courts, and the Supreme Court. And he is also someone who has a wealth of experience in policy matters. So over to you, Shahid. Floor is yours.
Thank you, Raj, and good evening, all the participants. It's a pleasure speaking to you this afternoon on the direct tax proposals in Finance Minister's budget. As we were listening to the budget speech, it appeared that there are not many or major changes in the direct tax side of the finance bill that was presented to the Parliament. But then, as always, looking into the fine prints of the finance bill and the memorandum, one finds that there are quite a few tricky changes which require examination and understanding and then application. So therefore, let's begin straight away with the direct tax proposals. First of all, one proposal which has received the highest attention of everybody around in the parliament, as also amongst the tax people and the salaried classes, is the alternate tax regime, which was actually introduced by Finance Act 2020, but which has been substantially modified this time, and which has been made default default tax regime, which means that unless you opt to go outside this regime, you will be taxed under this regime. So for individuals, and then it has also been expanded to apply to individuals as well as association of persons, body of individuals, and artificial judicial persons. I mean, a lot of things. So what has happened is that the earlier scheme did not receive much attention or much appreciation from the tax-paying public. This basically provided that that in case for those who were opting for this alternate tax scheme as it existed earlier, they were not eligible for a number of deductions. They were not eligible for standard deduction. They were not eligible for deductions under Chapter 6, except for the deduction relating to the national pension scheme. So therefore, there were not many takers for this scheme as it was implemented by Finance Act 2020. So what has been done is that, number one, it has been made more attractive, first of all, and then it has been made the default regime. So what they have done is that, first of all, they have reduced the tax rate, they've reduced the number of slabs, they've also reduced the applicable tax rates by a small amount, but there is a reduction, and they have also allowed standard deduction, because that was the biggest, the negative factor in respect to this scheme earlier, because those who were opting for this scheme were not eligible for standard deduction of 50,000 rupees against salary income. So therefore, three things have been done. Number one, of course, is it has become a default scheme. That is, unless you specifically opt out of it by filing a return and by filing a declaration before the due date for filing of return, you will be taxed under this scheme. Number two, you will be eligible for standard deduction, but not other deductions except for contribution to the national pension scheme. And the third thing that has been done is that marginal relief, which was earlier available to all taxpayers up to 5 lakh of income, has been raised to 7.5 lakh, but has been made available only for those who are opting for this, who are going under the alternate tax regime. So therefore, those who are going for this alternate tax regime will be eligible for no tax if their income is up to 7.5 lakh. So this is in summary the issues relating to this alternate tax regime. I mean, the jury is still out as to in which case it will be beneficial to remain under the old scheme or opt for alternate scheme. I mean, that working will depend upon the actual facts of each given case, because it is possible that in certain situations the overall tax effect may be lower under the older regime rather than under this regime, but then that's a matter of facts obtaining in each individual case. So everybody will have to assess for himself whether it is beneficial for him to be assessed under this scheme, the modified alternate scheme, or continue to be assessed in the old scheme. So that's point number one. The other is that once you have opted for continuing with under the older scheme, you will not be allowed to change your option except on one occasion in future. So only one chance will be given to you in subsequent years to go back to the old scheme. So that's another thing that one has to be careful about. Now moving to some other changes, tax rates. There is no change in tax regime for non-corporates who are continuing to under the old scheme, except one, and that is a substantial change. It is applicable to those who are having incomes above 5 crore. The surcharge, which was 37% of tax earlier, has been reduced to 25%. The net effect of this is that the effective tax rate for persons in the tax bracket of 5 crore and above comes down from about 42.9% to about 39%. So there is a relief of 3% of tax in respect of persons having incomes above 5 crore. Then in respect of companies, there is no change, no change in tax rate either for domestic companies or foreign companies. There are one or two very interesting changes in respect of TDS. First, of course, is this interest on listed debentures, which was earlier exempted from TDS regime, has been brought into, which is more of a minor change. The bigger change is this online gaming and betting. This is, I think, one of the key changes that has come in this finance bill. Online gaming and betting, which was so far liable to TDS at the rate of 10%, in the same provision which related to lotteries and horse races and all that, has been taken out from that provision, and a new provision has been introduced, which is section 192BA. And in that, the provision is that the person paying winnings, net winnings, to anybody who is participating in an online gaming will be required to deduct tax at the rate of 30% from before releasing the winnings to the winner. So that's it, and this also requires a substantial amount of compliance, which will apply both winnings paid in cash or paid partly in cash, partly in kind, just like that. What was done with virtual digital assets in last finance bill has been brought in the same manner in respect of online gaming and betting in this budget. Another change which will also affect lots of people is in respect to remittances under the liberalized remittances scheme, where the tax rate, where the TDS rate has been increased from 5% to 20% in respect of remittances other than those for educational and medical purposes. Moving over to something else, business income. What is happening on business income? There are not many changes in business incomes except for a couple of things. One, of course, is this presumptive taxation, which was earlier available to small businesses with turnover up to 1 crore and professionals with turnover up to 50 lakh, has been expanded. Now it will be available to businesses with turnover up to 3 crore and to professionals with annual receipts of up to 75 lakh rupees. So they will be able to opt for presumptive tax at 8% and get done with it without tax audit and other requirements. In respect of startups, two changes are there. One, of course, is that they've extended the sunset clause from 31st March 2023 to 31st March 2024, and then the period in which the losses can be carried forward has been extended from 7 years to 10 years. So that means a registered startup will be able to set off its brought forward losses up to 7 years. Now, another change which the finance minister was especially pointing out as a relief to MSME sector is that in cases where where any taxpayer has to make payment to MSME and it is not paid within the time provided under the MSME Act, then it will not be allowed as a deduction against the income of the payer. That means it will be allowed only on actual payment basis, not on accrual basis. This will be some relief to small scale industries. Then in the case of entities in SEZ, a provision has been added that unless the receipts are brought in foreign exchange within 6 months of the end of the year, the deduction in section 10 capital AA will not be available. And then there is one change about amortization, which has been changed to self-certification basis. Capital gains have again some very interesting changes. One, of course, is that there was this provision where capital gain arising on transfer of immovable property was eligible for exemption if the sale proceeds of the capital gains is invested in purchase of a new house property. Now that provision remains as such, but it has been capped that whatever may be the cost of the new property that you purchase, it will be deemed that that maximum amount will be capped at rupees 10 crore. So therefore, in other words, a limit has been put on relief available in respect of capital gains under this provision. Another major change which will affect quite a lot of new businesses is in respect of intangible assets and rights. See, these are where these intangible assets or rights are self-generated assets. Their cost of acquisition will be taken as nil, which means that if you acquire certain right intrinsically by developing an IP or by some measure other than purchase, then the cost of acquisition of that right will be taken as nil when you transfer that right to somebody else. So intangible assets and intangible rights will be subject to capital gain now, treating their cost of acquisition as nil. Then there is another change which relates to market-linked debentures. Now, what the explanatory note says is that these market-linked debentures are hybrid securities which have features of both debentures as well as equity. So therefore, they should be taxed as short-term capital gains. So the provision is that capital gain arising on market-linked debentures will be treated as short-term capital gains irrespective of the period of holding. Another change is with respect to a new scheme which is coming up called Electronic Gold Receipt Scheme. This has been provided earlier in SEBI regulation. SEBI has been authorized to declare gold vaults, some units as gold vaults, where physical gold can be deposited and converted into electronic gold receipts. So therefore, there is consequential provisions that conversion of physical gold into electronic gold will not be treated as transfer. So therefore, there will be no capital gain on this. The last one, that is income from other sources. Again, there are some interesting provision here also. We already had a provision where investment in shares of unlisted companies over and above their fair market value was regarded as income from other sources in the hands of the company. This was applicable only where resident shareholders were purchasing those shares. This has been expanded to cover non-resident shareholders also. So which means that in case non-resident shareholders purchase shares of unlisted company at a price higher than the fair market value determined as per prescribed method, that difference will be treated as income of the company. Another major change is coming in life insurance premium. The finance minister merely mentioned EEE, but actually this is a very big change. What is being proposed is that if you invest in life insurance policies with annual premium of 5 lakh or more and receive anything from that insurance policy, including bonus, in over and above the aggregate premium that you have paid, then that amount will be treated as taxable income of the year in which it is received. So therefore, what it means is that any surplus that you receive or any excess amount that you receive in respect of a life insurance policy over and above the aggregate premium, that will become taxable. Only thing is that it will be applicable only for new insurance policies taken after 1st April 2023, and this will not apply to cases where the payment is in respect of on account of death of the insured person. And the third change is that these business trusts, real estate investment trust and investment trust, in their case, income arising to the trust from dividend, rent, and interest is passed through the case of the trust and is taxable in the hands of the unit holders. Now, the memorandum says that in some cases, redemption of these amounts will also be passed on without being taxed either in the hands of the trust or in the hands of the unit holders. So what they have now provided is that in case of the redemption amount given to unit holders is more than the cost of acquisition of those units, then the difference will be taxed as income from other sources. That's all I have on the direct tax side. I'll be very happy to take questions as they come. Thank you.
Thank you, Shahid. I think we don't have any questions from the participants as of now, but we can certainly look forward to having some more questions at the end of the presentation. So after that, really insightful talk on direct taxes and certain changes, what are the implications, as Shahid very clearly elucidated. So time to move on to the indirect tax regime and what is happening there. So we have two very renowned experts going to make that presentation today. So the first of all, we have Reena Khair. She is a senior partner in the firm and she heads our indirect tax and international trade practices. So Reena comes with a huge amount of experience in handling matters before various tribunals, high courts, and also, of course, Supreme Court. And to her credit, she has over 300 reported judgments. And in the space of international trade related matters, she frequently appears before the designated authority, Director General of Trade Remedies, etc. And she has successfully argued a host of cases in relation to anti-dumping and anti-subsidy matters. Along with Reena, we have our partner Shampa Bhattacharya, who's also going to speak on indirect tax related proposals in the budget. Shampa has a vast experience working on a variety of indirect tax related matters, including goods classification, imports under free trade agreements, special valuation bench matters, anti-dumping issues, and export benefits. So over to you, Reena. And once Reena completes her presentation, Shampa will take over. Over to you, ladies.
Thank you so much, Raj. So, Raj, this budget for those in indirect taxes was a little disappointing because there were no landmark changes, where we could say that there's a wow factor or any particular industry had been identified that, this is an industry which really needs support from the government. So in the absence of that, I would say that this is more of a tinkering with the rates and the legislative amendments, and I'll come straight to it. As far as Customs Act is concerned, about 2-3 years back, the finance minister had said to us that there were a host of exemptions which were resulting in a lot of disputes. And in order to reduce those disputes, about 180, 190 exemptions were sought to be withdrawn. Rather, they had said that they are going to review them one by one and decide how many need to be retained. I think effectively the government found it very tough to review all these exemptions because they covered a whole host of industries. So what they did instead in 2021 was that they said all exemptions are going to be valid only for 2 years, and unless they are extended, they will automatically lapse. Now, in the current budget, what is proposed is that certain types of exemptions have been excluded from this lapsing business of 2 years, The main exemptions are those, for instance, which relate to free trade agreements or are pursuant to treaties, because those agreements and treaties are, there is no time frame under those agreements. They are valid for a very long time and certainly not 2 years. Then privileges of constitutional authorities, schemes under foreign trade policy, for instance, if you are operating under an advance authorization scheme or an EOU scheme, for easily 4 years, 5 years, 10 years, 8 years also. So naturally, this 2-year was causing some hindrances. Central government schemes with validity of more than 2 years, re-imports, temporary imports, gifts, personal baggage, things like that. And also IGST, which is levied on imports. Exemptions under IGST, automatically the 2-year limit got imported. So they've made it clear that for IGST, these limits will they have, I think, put some discipline for the Settlement Commission. Earlier, there were no timelines within which the Settlement Commission had to pass an order. Now there is an amendment made that they have to necessarily pass the order within 9 months, and they have an option to extend if there are justified circumstances. But what is very peculiar in this is that if the Settlement Commission for any reason fails to pass the order either in the 9 months or the 3 months, then it will be as the application was never filed and the party will go for adjudication. Now, the reason why I feel this is a very odd amendment, because routinely we have such provisions in courts. And if courts are not able to meet the timeline, you cannot make the applicant guilty for that, or you cannot make the applicant suffer. So if a settlement commission is not able to complete within 9 months because it has too many applications, how can you make the applicants responsible for that? In fact, it is the government's fault that they need to have more commissions and more judges and all those things. So making an applicant suffer is certainly a strange consequence of non-adherence to the time limits. But I suppose what the authorities perhaps have in mind, that people may be filing applications and taking frequent adjournments and somehow dragging these matters on for very long. So perhaps it is to curtail that, but I hope the Settlement Commission itself is not responsible for these delays. Then there has been a very important change to the anti-dumping and subsidy provisions. Recently there has been a lot of litigation on the point whether the power to impose duty by the central government is a legislative power or not. And various high courts, Supreme Court and tribunal have taken away that no, because there is an appeal against the notifications of the central government, therefore it is a quasi-judicial process subject to judicial review, and an appeal lies to the tribunal and a writ petition also lies to the High Court. Now, with the amendments made this time in the budget, and interestingly, they have been made retrospectively till from 1995. So when the act came, so the idea seems to be, I think, to overcome the High Court judgments and Supreme Court judgments by these amendments, and to lay down a new law that government is sovereign, supreme, and its decisions are not subject to any review by any authority. That is, I think, the object of this amendment. But I have my doubts that this is the end of the litigation, because the amendments itself seem to be quite dubious. They seem to be contrary to basic constitutional principles. So I think there's a long battle ahead for the Indian industry and the government on these unfair trade practice laws. Highlight some of the changes made in the rates. Of course, this is not exhaustive, but some of the major changes. There are not too many changes this time. Rates for styrene have been increased, vinyl chloride monomers. These are mainly used for plastics, paints. Jewelry has been increased marginally. Bicycles have been increased. Aircraft and aircraft tires have been reduced. Of course, for aircraft, even a 0.5% reduction is quite a substantial reduction because the value of aircrafts are so high. Then glycerine, denatured alcohol, and some of these other items, they have value, their rates have been reduced. I think possibly these reductions are because, we want to make India a global manufacturing hub. So they want to make sure that the raw materials are at the lowest possible rates. These are raw materials for manufacturing activity in India. Silver door bars, here again, duties have been increased. But I think we have to keep in mind that gem and jewelry, the gold, the silver, the diamonds is one of the big export sectors for India. Those will, of course, not be affected because these duties will not be applicable to them. Other changes seems to be that inputs of mobile phones and televisions, the duties have been reduced. Interestingly, vehicles, including electric vehicles, the rates have been increased, whether in semi-knockdown or complete built unit. In both situations, the duties have been increased, and it's a little unfortunate. I could understand vehicles standalone were increased, but unfortunately, electric vehicles have already also been increased. And, the impetus to the environment, which we were hoping with the electrical vehicles, will be a little dampened with this. Toys, unfortunately, for children going from 60 to 70, compound rubber, also an increase. I think compound rubber, one of the main reasons for the increase is, in Southeast Asia, especially Indonesia, Malaysia, there's a lot of rubber coming into India at cheap prices. And the rubber board in India is finding that rubber in India is not commanding a good price. And I think perhaps it's from that intent that duties have been increased. Many other duties reduced, for instance, for manufacture of connectors, lithium-ion cell batteries for electric vehicles. Duty on coal, peat, and lignite has increased. I would say out of 196 exemptions, 146 exemptions are being extended for a period of 1 year. That means even the existing exemptions of 146 I think the government is uncertain how long they want to keep these exemptions. They are just giving them a life for 1 more year. And I think rather than going through the trouble of withdrawing the exemptions, they are hoping that they will lapse and there will be less of a hue and cry. Cigarettes, the usual targets, duties have increased. And I think these are the thin commodities, as we say, alcohol and cigarettes. Central excise duty on blended CNG has been reduced. This is obviously a welcome move. And I think I will conclude here because there are really not that many changes on the customs side. I think there are many changes on the GST side, which Shampa will explain.
Thank you, Reena. Shampa, floor is yours.
Greetings, everyone. Much awaited hype of the GST changes just before the last budget of the general elections. So let's see what's in stock. Allow me a moment, please.
I think some technical difficulty, Shampa. Hopefully, right at times.
While we wait for Shampa, Reena, one quick question. I read somewhere that something to do with import of those products for making lab-grown diamonds. There's some
Yes.
duty cut or something like that. So the government wants us to make lab diamonds, is it?
So these are synthetic diamonds, artificial diamonds. And as you know, one of the biggest exports for India is the gem and jewelry sector and the real diamonds, where diamonds come to India for cutting and all those things. But because of the price sensitivity, now artificial diamonds are also a big growth area. And I think India should step into that game early, so that at the seed level, they come to India, we do the cutting, the polishing, fixing into, finished jewelry for exporting abroad. So definitely a positive mood. I think Shampa is back.
Ready, yeah.
Okay. Hi, sorry for the technical glitch that we were having on the slide here. So let me take you through the GST important legislative amendments that we have seen this time. And to begin with, the much awaited CSR activities and the ITC involved by a corporate has always been a hot topic or discussion, not only among the taxpayers, but also with the taxing GST authorities. So a much awaited clarity has been provided in this budget, which says that the ITC on such expenses which are used by corporates would not be available. So that makes it a little more simpler for corporates who are going into CSR activities and pumping in a lot of expenses, considering that the ITC would be available. So we need to hold our horses back and think that, okay, the ITC on that is not available. Certain transactions like, going on to high sea sales or supply of warehouse goods before home clearance were made outside the purview of GST with effect from 1st Feb 2019. However, there were much ambiguity regarding the taxability of such transactions during the period 2017 to 19. So accordingly, this budget has provided a provision which says that transaction is outside the purview specifically for the period with effect from 2017. However, no refund of tax paid shall be available in cases where any tax has already been paid in respect of such transactions or activities.
Sorry, I think Shampa is experiencing some glitch.
I'm back. I think the camera is giving some issues, but let's go ahead at least with the audio here so that at least people are audible and we can continue it like that.
Sure.
What we were discussing is from period of 2017 to 2019, the particular ambiguity regarding taxability of such transactions of high sea sales or supply of warehouses have been specifically cleared, and it's no longer taxable. However, we need to also know that this particular provision, which has been clarified in this budget, says that no refund of tax paid shall be available in cases where any tax has already been paid in respect of such transactions, activities during the period 2017 to 2019. So now coming to why has sales from bonded warehouse now been considered as exempt supply? So there is a specific ITC restriction that has been introduced this time, which says that, ITC on sales made from bonded warehouse will be treated as exempt supply, and ITC would not be available. So no, it's not subject to GST, so it's not treated as a taxable supply. And since it's a form of a part of the Schedule 3, we clearly take it as an exempt supply. So it's more of a clarification which has come in, which again says that since it's an exempt supply, the ITC on it is not available. Now coming back to where we had that in case of ITC, what happens if the payment is not made by the recipient within 180 days? So the recipient in this case would be liable to pay tax along with an applicable interest in case the payments are still not made within 180 days. There is a good initiative here that the GST returns and statements are allowed to be filed or amended to a maximum period of 3 years, which was not allowed initially. So that period of 3 years, however, is extendable depending as to what the commissioner and the council decides further on. Coming into a very interesting point with respect to a place of supply for services which are used for transportation of goods outside India shall now continue to remain in India, unlike earlier, where the place of destination of goods was considered as the place of supply. So let me just take you through this, that initially what happened is the place of supply for goods which were transported outside India. The destination of goods where they were received was considered as the place of supply. However, with the removal of the provision, now the place of supply continues to remain in India. So if it continues to remain in India, how the taxability is definitely getting affected, and that is a point of question that we would like to deep dive and delve into. Okay. The proposal has, now let's look into e-commerce operators. There is definitely a benefit that the e-commerce operators have provided to unregistered suppliers and also who deal into goods and use the platform of an e-commerce operator. It has enabled them to actually go in for composition tax, unlike where the goods and service players were restricted under the earlier regime. However, now for suppliers of goods, they can still go into composition scheme. It has also made intrastate supply of goods through e-commerce operators easier, subject to certain conditions. However, any controversion which is done by an unregistered seller of goods or services through an e-commerce platform, the e-commerce platform operator is penalized on his account. So the e-commerce platform needs to definitely keep a check on how an unregistered dealer here is operating through his platform. The most important change that we've witnessed this time is non-taxable online recipient, also known as the OIDR services. The revision in the definition of non-taxable online recipient by removing the condition of recipient of online information and database access or retrieval services for purposes other than commerce, industry, or any other business or profession has definitely expanded the tax base here in India. Initially, it used to say any services other than commerce industry. Now, in this case, if we include it for commerce and industry, so of course, we have a wider tax base. So by any unregistered person located in non-taxable territory to an unregistered person receiving the said services and located in the taxable territory shall be taxed here. So there was a specific requirement of being an unregistered person plus some government and local authorities. So they have conveniently removed government and local authorities from the definition. However, it has been covered specifically under the registration section of the GST, which says any entity which could be a government, local authority who is deducting TDS and has been notified would be covered as an unregistered person. So it's a loop where it's been removed from one end, but it's getting covered at the other end. So except a change in the definition, which is not effectively making any change, that's how it's been brought about. But definitely removal of the word commerce, industry, or any other business or profession has increased the wider net. We see a cohesive approach by the government authorities here, enabling sharing of information furnished by the registered person in his return or application or registration or any other kind of document, which could be an e-way bill or any other details on the common portal with other systems. This should surely be an ease for the taxpayers who are required to furnish information repeatedly in duplication with different authorities. So generally, income tax authorities and GST authorities work in tandem to understand that how the income is generated, and that's how they take a taxpayer in loop. So this kind of sharing of information should definitely be an ease for the taxpayer, because he would not have to continuously submit and repeatedly give the information, and it can be accessed easily. Also, there is an important change where we see and welcome move, in fact, which says that the compounding amount of various offenses, the penal offenses under GST, which used to be at a higher amount of 50 to 150% of tax amount, will now be reduced to 25%, ranging from 25 to 100%, which is definitely a relief. Not a complete relief, but yes, we're looking to the positive side of it. We also see that the monetary threshold of tax amount for launching prosecutions under the GST has been increased from 100 lakhs to 200 lakhs, except for issuance of fake invoices without supply of goods and services. So for fake issuance of invoices, the threshold limit does not apply here. I think more or less that's all we have from our GST perspective. Well, looking from a very major legislative changes, yes, there are changes, but once we do a final reading of the print, we would actually like to give in more details about how it has affected us.
Thank you, Shampa. And I think this is just about time. So we have another few minutes before we need to conclude this. But if there is any question from the participants, I have a few questions which I have received. But meanwhile, if there is anybody else who wants to put up a question on the chat box, please feel free. So to begin with, I'll go to Shahid. In fact, there are two questions. So first up is, how does the income from online gaming gets computed for TDS purposes?
Thank you, Raj. Actually, if you remember, last budget, the ministry had introduced assessment of income from cryptocurrencies or crypto assets. They followed almost the same line in this finance bill in respect of online gaming. First of all, they have defined what is online gaming, what is computer resource used for the purpose of online gaming, who will be responsible for withholding that tax, and then they've said that this will be on the net winnings. So what is being taxed is net winnings from online gaming. No expenditure will be allowed against that, and it will not be allowed to be adjusted against any loss from any other source of income. For example, if you have losses from business income and you have gains from online gaming, then the income from online gaming cannot be adjusted against losses from business or from any other source. So it will be a net tax of 30% on the net income from online gaming, and the responsibility to direct that tax is on the party which is required to make payment of those winnings. And then they've also provided that in case the winning is partly in kind and partly in cash. That means if it is in terms of coupons or some bonus points or some such thing, which is not, and it is not enough to cover the tedious part of it, or 30% is not being covered by the net winning in cash, then the payer is being made responsible to make sure that first the person concerned deposits that difference, and then only the balance amount will be released. I mean, so it's a fairly comprehensive and strict regime which is coming into force from 1st April 2023 in respect of online gaming.
Sure. I'll come back to you, Shahid. There is a very important question which has come, but before that, let me just quickly go to Reena. Reena, you mentioned about the the Make in India. You referred to that Make in India and other initiatives that the government is taking. So, what more do you think needs to be done from an indirect tax perspective to make India a manufacturing hub?
That's the most important thing, is that sometimes it feels like there's a somewhat of a confusion. Do we want to be a country which shields itself from foreign imports? Or do we want to be a country which, is so confident in the export markets and thinks that, they can export and really succeed? Now, if you want to be a manufacturing hub, it means that you want to manufacture not only for India, but for other countries also. That's really what a manufacturing hub means. And today, with the integrated supply chains, raw materials, it's not possible that all the raw materials, imports, components, parts, technology will all be available in a single country. And due to this integration, to be a facilitator for import of these items for the manufacturing to succeed in India. So I think while of course we heard some huge number of compliances are going to go down and there's going to be centralized filing and PAN is going to be the identification, many other relaxations. But certainly I think we have to stop thinking of taxes as especially customs duty, as only a measure for collection of revenue. We have to also think of how allowing imports of raw materials at concessional rates is really going to give us dividends, because of course now we see mobile parts and other things, mobile phones, televisions are coming, but there are many products for which facilitation in terms of import of certain critical raw materials can lead to a boom in India, especially because there is a gradual shift away from China.
Right.
And countries like, Vietnam and all, who were initially a very preferred destination, in fact, that, these countries are too close to China and can be under the influence of China. Like they say, when China stands up, their shadow is on top of Vietnam. So, they want to go to countries which can stand up in their own right, like India. So I think there is a tremendous scope for foreign investment. I think there are so many opportunities. I think government of India is conscious of that. They are making the changes, but one feels we want much more in a shorter time. So I guess there is some amount of impatience in the industry.
Absolutely. And, like you mentioned in your presentation, what was a little surprise and maybe a disappointment was the provision relating to the EVs. We expected that EV should be something which would be a priority sector for the government. Anyway, going back to Shahid, there is a question from Mr. S.K. Verma, who is writing from Indian High Commission in Ottawa in Canada. So Mr. Verma's question is, considering that FDI is an important cause of increased economic activities in India, are there any notable changes announced in this budget, including on attracting foreign pension funds?
No, I don't see any specific provision being introduced in finance bill in that particular team. Whatever benefits are there are already available. No new incentive has been provided. There are some changes in respect of International Financial Services Center, Gujarat, but those are merely expanding the provisions of some of the exemptions which were earlier available. They have expanded that or made it more simple to obtain those expenses. But there is nothing for foreign pension funds specifically in this.
Yeah. While we do recognize that pension funds are big players in the FDI segment, but as you note that there is no specific provision or specific allowance that has been made. So moving to Shampa. Shampa, there is a question from you from Mr. Ashish Sanghi. He asks, under GST, it is explained that recipient is liable to pay tax with interest if payment is not done in 108. In this case, do recipient has to pay under RCM and whether he can claim ITC?
Okay. See, once a tax invoice is generated by a supplier and the amount hasn't been received by the recipient, what happens is the recipient is definitely entitled to claim ITC because the supplier actually reflects his tax invoice as an outward taxable supply, basis which the recipient is entitled to take credit of the same sale which has happened. Now, in a case where the payments have not been made by the recipient, right, the tax still needs to be paid in a way that I have availed my input tax credit already. So either I reverse it and then pay interest on it, or if I'm not reversing it, basically it says that I pay tax on it is the same way that I have to reverse. So if my sale has already been reflected in my returns by my supplier, basis which I take an ITC, and for which I haven't paid, that ITC has to be reversed. And an applicable interest has to be paid because the amount has actually not gone to the government treasury, neither has the supplier received the amount. So it's not a basis of paying the tax on a reverse charge basis here. It's basically saying that the tax that has been not paid or for which the ITC has been availed by the recipient has to be reversed.
Sure. I hope that answers the question.
Shampa, just to
Sorry, go
supplement,
ahead,
Shampa,
please.
I think perhaps this condition may have limited applicability because when you're paying under reverse charge, possibly your liability or your eligibility comes, your liability to tax happens when you receive the supply, and your liability to, your eligibility for credit also arises at the same time. And of course, in a forward purchase, certainly that becomes very relevant.
Yeah, depending on what's the transaction. Correct, Reena. Thanks for that. Yeah.
Okay. Shahid, I had a question, and it was quite a surprise to see, the provision relating to income from other sources where any money, share application money or acquisition of shares price, which is paid over the fair market value, now is, and particularly from the non-residents. Earlier, it was restricted to residents, but now even non-residents would come under that loop. So does it also include to a situation like Shell, where, say, a Mauritius holding company invests money in its downstream subsidiary in India, and this investment is done at a huge premium over and above FMV, of course. So does that then now tantamount to income from other sources in the hands of the Indian entity?
See, this provision was brought in several years ago, basically to tackle this problem of penny stocks, where penny stocks were purchased and then people were investing large sum of money on premium with these companies. So to tackle that, this provision 5627B was brought in, I think in 2016, if I'm not wrong, but it was limited to residents. Then they excluded venture capital funds and angel investment funds and all those preferred categories of investors from the purview of this particular provision. Now, in this budget, in the memorandum declares it to be an anti-abuse provision. It is under the category of anti-abuse provisions, where they have said that this provision will also be applicable to non-residents. But other exclusions which are there, which were there earlier, are remain. So therefore, venture capital funds and all those will not be affected. And they have also said that the method of valuation for determining fair market value will be prescribed later. So we'll have to wait for that. That what is the method that they have. There is already a Rule 11 UAA for valuing these shares. Whether the same rule will apply or whether they will bring in some change, that we'll have to see.
But would this not lead to some degree of confusion? Because particularly in the context of the non-residents, because when you say that the rules for valuation would be notified later, because there is already a set of standard which is prescribed under FEMA. So now if income tax comes up with a different set of guidelines, then that would lead to some degree of confusion, right?
That kind of conflict is already there. I mean, there are different rules of valuation for FEMA and for income tax in several other situations also. So that will be there. But how exactly this will be implemented, I think it is brought in to effect from 1st April 2023. So therefore, it's not for past investments; it is for future investments. And how do they carve out, the desirable categories of foreign investment? That we'll have to see.
Right. I think there are no further questions. Sorry, there is one more. Let me just. Yes, sorry. There is another one last question from Mr. Anil Kale to you. I think Shahid, you need to take this. It says earlier for professionals under presumptive taxation, there was 50% deduction up to 50 lakhs. Any change in this?
No. The earlier provision was that those having business turnover or those professionals having professional receipts up to 50 lakh, they can determine their taxable income on presumptive basis as 50% of the annual receipt. Supposing your annual receipt as a professional is 40 lakh, so your taxable income will be 20 lakh only. So that was the provision. Now, what they've done is that they have increased the eligibility criteria for both business categories as well as for professionals. Now, this scheme will be available to professionals who are having incomes up to 70 lakh, who are having turnover or annual receipts up to 75 lakh. The income will be computed at 50% of that receipt. Supposing your receipts are 60 lakh, so your income will be computed on presumptive basis at 50% of that 60 lakh, and the tax will be computed at 8% of that.
I hope the confusion is now clear on that front. So if there is no other question, I think then we can close this session. Or is there any other last question that the panel can answer? No, I think no further questions are there, so we can end the session. Thank you all for your participation, and I'm sure you have taken away a number of inputs that our panelists have shared with you. And of course, like all three had mentioned, now we have to wait for the fine print to understand how this is going to pan out. And I go back to something that Reena said when she referred to that retrospective taxation of some of these provisions. This is not the end of the story. We have to wait and see how it unfolds. Thank you all and have a great evening.
Thank you. Thank you, Raj.
Thank you, Raj. Thank you.